Good evening, ladies and gentlemen. Always difficult speaking to people that you can't see, but we will try and work our way quickly through our presentation. Apologies for those that know a bit about the business. The first few slides are general reminders of what we do and how we do it before we get into the actual numbers. So just a quick canter through the UK tissue market. Substantial size at 2.2 billion at RSP. 1.5 billion of which is retail sale. The consumer sector is dominated by the major multiples, as you would expect, at 72% of the marketplace. The discounters, our heartland, is 16% of the consumer sector, but is the fastest growing. The total market is in slight decline, but that's really down to promotional activity and the growth of the discounters dropping down unit price. The brands continue to lose to the other brands, so in terms of own label, it is actually winning. In terms of the marketplace, we're one of the 5 biggest players, and they're well known: SCA, Kimberly-Clark, Sofidel, etc. And the market below us, really you drop down to about 25 million below our sales turnover, and there's a lot of small companies that occupy that space. In terms of our range, what do? We've got a one-stop shop. We supply a full range of products across all tissue categories, mainly into the multiples, and then we do away from home products into non-retail, so hotels, restaurants, offices, etc. In terms of sales, our discount market, as you can see, is growing at 10% per annum, and that continues to be our heartland and continues to grow at 10%. We have taken on bigger and bigger space in that marketplace and now have, as of the end of last year, 50% of that marketplace by share. In terms of technology, and we'll come on to a little bit of this later on, we've invested substantially. We currently have 17 conversion lines, including the 2 new ones at Leyland, and our tissue conversion capability allows us to do a whole range of products.
In terms of product categories, there's 4 main product categories that we operate in. There's toilet tissue, kitchen towels, facial tissue and away from home. Toilet tissue showed the greatest growth, 67.5 million. The growth in the category is largely driven by where the capacity goes down, and the majority of our investment in those machines Steve's mentioned has been into toilet tissue. We're running now currently at about 540 employees, just to give you a sense of scale.
Slides, there we go. There's a quick walk through our key customers. For those that know, Booker's our single biggest customer. It's no accident that Tesco sat next to it, because clearly that's going to have an influence on the business going forward. And we have a wide range of discount customers, but clearly we've got a small foothold in the major multiples. Just in terms of our model, as you're aware, we're the biggest paper conversion business, we like to say, in the world that doesn't have a paper mill. That model we're still wedded to. In terms of UK consumption, 300,000 tonnes is imported each year, of which we are 1/3, and we basically source parent reels from across the world from a stable of, it's actually 22 mills now, and we use that commercial leverage to get the best deal, but we tend to trade with 6 or 7 at any one time to give us 70% of our purchases. In terms of the marketplace, again, the reason that we're wedded to the model is that there is oversupply in the world tissue market. There is in fact 6.2 million tonnes of spare capacity in tissue manufacturing that's on the ground for this forecast for this year, and it's actually forecast to increase by another million next year to over 7. So that helps us drive our point of difference. It also allows us to take advantage of any changes in the marketplace that come through quickly in terms of technology, because we're not wedded to old kit.
In terms of FX and hedging, the UK is a net importer. Fluctuations in global pulp prices and exchange rates impact both paper manufacturers and converters to the same levels. Majority of our purchases are in US dollars. We do buy a small amount in euros. We do hedge. The policy is to hedge for 6 months. However, we have taken a longer view on that in terms of FY17 and into FY18.
So that's given you a brief overview. Apologies for quickly running through it. We'll now take you through some highlights of the year ended 30th of April, and then we'll go into a little bit more detail on the various platforms of our strategy before James takes us through the numbers. So the year, we traded in line with expectation despite a very challenging economic environment. Clearly, when we did our IPO last June, a number of events followed, whether it was the referendum vote, whether it was the American elections and our own elections. So we are working within troubled times. So we are reasonably pleased that we've come in line with those expectations despite those factors. So our revenues grew 14% to 135 million, and that's mainly driven through private label and the discounters. So as previously mentioned, we've now reached 50% of the discount market, and we do believe that that will continue, and clearly in the year was driven by the Lidl contract.
In terms of some of the key financials, adjusted gross margin, which strips out the revaluation on the derivative contracts, remained largely flat, supported by favourable parent real pricing and the hedging I referred to earlier. Adjusted EBITDA was up nearly 7%, 1.1 million up to 16.1, and the adjusted profit before tax, which excludes exceptional items and the movement on the currency contracts, was up almost 4 million or 57%, with the majority of that increase supported by a reduction in the interest charge as a result of going through the IPO and restructuring the debt.
Sorry, technical hitch. There we go. In terms of our operational investment, clearly as promised, we brought Leyland online and completed the commissioning of our first 2 lines within Leyland on time. Slight delay in the second line due to some revamp work, but I'll talk about that a little bit later. When fully operational, this will take our total capacity to just under 150,000 tonnes or circa 180 million pounds of sales turnover. At the same time, investing in our platform for growth, as we call it, we've completely reviewed our supply chain and logistics and have been through a process of rationalisation of our warehouses to move from 6 or 7 down into one big shed. And just to give you an idea of the size, 368,000 square feet is the equivalent of 5 football pitches and will accommodate up to 200 million pounds of the sales. We've outsourced that to NFT after a tender process because we believe that we should bring in proper expertise to help manage our warehousing and logistics.
Net debt since we floated has reduced 4 million down to 19 million with an increased return on cash from operations, which has gone up 2.6 million or 23% year on year.
One of the big questions that we did have in terms of managing the transition is would we be able to do that? And I think we're happy that we've successfully transitioned from a family business to a listed business with the support of the family, and we do thank them for that. To backfill their roles and functions, we've clearly employed a number of new hires in key functions around manufacturing, supply chain, etc. And as we committed to earlier and upon IPO, we are proposing a 4p share dividend with the blessing of the board, which will take our total dividend to 6p. So a few slides on strategy. This is really talking about, so what are our platforms, what are the actions that we've delivered in the year, and what are the KPIs against which we measure ourselves. So firstly, we have an ambition to grow the business over a period of time, over the strategy period, to 250 million pounds, over 250 million, and that essentially is maintaining growth with the discounters and looking at the opportunities within own label business in the major multiples. In terms of our objectives, we must not forget that we need to maintain the confidence of our current customers as we also add new customers to our portfolio. So that's a key focus for us. In terms of how we're progressing against that, well, clearly you've seen that we've now achieved 50% of the discount market. that is not our limit. There's still further opportunity. The Lidl contract, which I think we talked about in January, came on board in October. It was challenging, but I think we can safely say we did a reasonable job for the customer, and I think they're happy. And generally, the marketplace will start to see substantial inflation as the referendum exchange rates bite, and I think it's well documented that across all categories, whether it's food or grocery, that there will be inflation. It's more a case of how much and when, and we genuinely believe that will also force shoppers to be more savvy about where they buy their products from and the quality that they buy. So in terms of our key performance indicators, I think those actually tell you what we've previously told you. The only big one that's probably different is that our total market share has moved from 7% to 9% within the year. In terms of protecting the margin, clearly we are looking to make sure that we source our parent reels as competitively as possible from all around the world, and we've talked about our model, and clearly wanting to make sure that we also protect our currency, and James will touch on that at different stages in the presentation, and obviously work with our customers to recover the inflationary costs, which we've talked about, which are on their way, whilst not losing sales, which is a very delicate balance. So in terms of progress to date, do you want to touch on or do you want me to talk about that?
No, it's fine. Key performance indicators. So we've touched on gross margin remaining pretty much flat at 28%, adjusted EBITDA, and adjusted profit before tax has also gone up 4.8 million to 13. It's 58% increase.
Okay, in terms of supply chain, a little bit more around service levels and building a model that is capable of growth. Clearly that matches our ambition in terms of sales growth, because it's not just about building capacity in your manufacturing lines. Because of the cube that's involved, it's about setting up a supply chain that will actually be fit for purpose over the coming years. So in terms of the progress, very swiftly identified a solution, and it's a rationalisation of our existing space down into one big shed, as we've described. The full transition into Skelmersdale is expected to be completed by the end of summer, August, which again from a start point is a very rapid progression, and we have put world-class systems in terms of warehouse management into Skelmersdale, which will allow us to improve our service levels, which is paramount whether you're a discounter or whether you are a major multiple. In fact, whether you're a small corner shop, service is absolutely critical. Our performance indicators, we have had some challenges as we've taken on new business, but as we exit the year, our volume fill is 99.6, which we're very pleased with, though there's always going to be inevitable small hiccups every so often. In terms of building the platform for growth, we've talked about increasing our overall capacity. Our progress to date includes an optimization plan, which I think we referred to in our last presentation. That's about improving the performance at Blackburn through machine enhancement, through staff training, and introducing a new shift pattern, which took place on May the 8th, early days for us. As far as Leyland's concerned, as we discussed previously, the two lines are now up and running. Line 1 is the bigger of the two, and we are very pleased with the performance and the quality of the product that we're getting from Leyland. And just as a reminder, Leyland has space for 6 lines in total, and as recently announced, we're adding a third line, which we've already ordered, which will give us another 15,000 tonnes or circa £20 million of revenue. In both sites, we've also taken on new resource, industry specialists, to make sure that we're always looking forward in terms of the quality of our people. Just to give you a feel for it, the exit capacity, I know tonnage is almost a language that people don't really understand. The capability with the lines that we've got and lines that are coming, the new line and the investment in Blackburn, will give us a capacity of circa £215 million of revenue.
So in
Now
terms,
over to James.
So in terms of the financials, we've got a summary P&L there. Revenues are up 14% or 16.9 million, which in terms of the pound value is very similar to the prior year, which was 17.1. Majority of that growth driven by new contracts with Lidl and additional business with Booker and Pound Stretcher. Gross margins were held flat at 28%, I've mentioned that before. We've had some investment in overhead in the year. Distribution costs have gone up as a result of higher sales, and we've invested in people as well as some PLC costs have been listed. Finance costs have gone down significantly. They've reduced 3.8 million or 77% as we've changed the debt structure. In terms of the cash flow, operating cash has gone up to 88%, which has increased by 11%. Investment into working capital has been minimal in the year versus the prior year, as we managed to keep a tight control of our working capital. The interest paid was similar to last year, but will reduce going forward as the more expensive loan note debt has been removed. And we spent 4.4 million on property, plant and equipment in the year. The majority of that related to start-up costs at Leyland, which were 3.4 million. In terms of the net debt has reduced significantly, as I've mentioned previously. We're now just over £4 million lower than where we were on float, and we were about 23 million on float. In terms of the balance sheet, I've gone through the majority of this. I've talked through the working capital, I've talked through the net debt. One thing we have now got on the balance sheet versus last year is the derivative financial instruments. So as part of what we have to do accounting wise is value the hedged currency contracts that are outstanding at the balance sheet date, and that's brought a liability of 2.9 million onto the balance sheet.
Okay, just a few comments on outlook. A number of areas of focus. We clearly are continue to build a platform for growth, and we're very much catching up and investing going forward. So the increase in not only conversion capacity but in our warehousing is all about transitioning into a business that can absorb substantial growth over the next 2 to 3 years. One of the key areas, and I know 1 or 2 questions have been asked about this, is inflation recovery. There is no doubt that the UK markets are all facing into this. We have already started to engage with our customers, and we had a phase 1 of price increase negotiations earlier in the year. We are looking for clearly retail prices to move, and they've started to move, because that will allow us to have a conversation about phase 2. But that's clearly part of maintaining our margin. And as we finally said, it's our aim to propose a 4p dividend once approved by the AGM. So apologies for a very quick canter through. I think that the summary is that we were pleased with the performance in the prior year, despite a difficult macro environment. But there are a lot of challenges going forward, as with any business, but we are on with those. So thank you very much.
Great, thank you, gentlemen. Very, very clear. I repeat that if anybody wants to ask a question, put that through over the internet now, but we have a number already. So let's start probably with you, Steve. Could you just give us a little more colour on how important is the quality of what you supply to your clients, i.e. it's not just a price competition, and have you got leadership in terms of quality when it comes to tissue converting?
It's a very good question. I think often there's an assumption that if a product's on sale in a discount market, it's not competitive in quality. There are a number of products that we supply out into the marketplace through our customer base that are actually best in class. And we know that because we independently test, or we send out for independently testing. And recently, a couple of our products actually came out on top in comparison to not only the leading brand, no names, and also against all the major multiple own label products. So we are confident that we are delivering quality.
And then staying on the client theme, Have you actually lost any clients in the last year? And perhaps that was not a disappointment to you. And then looking forward, as you aspire to get work on a national scale for the multiples, would you actually look at dropping smaller customers, or could they be accommodated?
Gosh, what a load of questions. We in any business you always gain and lose. I think we have lost the odd small customer. We have also chosen to lose customers if we can't agree a price. But generally we try and maintain our customer base and grow it. In terms of the major multiples, we wouldn't want to lose any focus on our core business. If we're searching for new contracts, we need to keep everybody happy and satisfied with great service. Yes, there may be a situation where products are rationalised, but certainly not looking to get rid of customers. We're trying to grow our business.
Okay. Right, James, couple for you. You've held the gross margin this year, but would that be impossible to repeat this year unless there are price rises to clients?
The short answer is yes. No matter how well or how far you hedge, at some point you have to face into where the spot rate is. And it's hovering around sort of 129, 130 at the minute. So the short answer is yes, you would need price inflation recovery, which Steve's talked about.
Okay. A slightly longer explanation required for the next one. Someone's researched and discovered that you've got a PhD in physics, but could you explain hedging in simple terms? Obviously looking at last year when there was a significant move in the dollar sterling rate from 145 to 125, there was a clear benefit to be short of the pound. But as you're renewing your hedging as you go along, you now have to deal with raw material costs at, call it $1.30. So presumably the purchasing of those contracts will not give you protection from the margin squeeze unless you charge clients more, as you said. And you would only gain from the hedge if the pound fell further against the dollar. Is that correct?
Short answer, yes. It's very, very similar question actually to the first question you asked. So basically, your hedging policy is there to mitigate the volatility in the foreign currency. No matter how well you hedge or how deep you hedge, at some point you will have to take a spot rate which may or may not be advantageous or disadvantageous to you. And that's part of the reason why you hedge. We don't hedge to make money out of currency. What we do is we hedge to take the volatility out, certainly versus our internal forecasts.
Right. Now, again, coming back to clients, there were some very good sales figures from B&M this week. When you're looking at a client that you want to win business from, do you try and identify winners? Or is it just a case that any discounter of a decent size these days is a good client for you?
I think the discount sector per se is a good sector. So wherever we can grow sales with whoever that may be within the discount sector, it's showing great growth. And that's really all about the UK shopper clearly wanting to find great value with quality. And we believe that we deliver that. So to be honest, we would take a view on any customer, but clearly the bigger the better. That doesn't mean that our small customers are not important and that we don't clearly want to give them service as well.
Okay, then a question on capacity, which you are expanding, and it looks like you'll have something like 40% more capacity than last year. How soon do you think that will be fully utilised?
Well, there's two elements. One is that we look at our base business and we plan forward in terms of the growth rates that we're expecting. And from the previous question, if you've got a large chunk of your business in the discount sector that's growing at 10% per annum, by the way, Aldi are growing and Lidl are growing at almost 20% per annum, according to latest figures, then some of that capacity will be for just simple organic growth within the business. But secondly, we're actually moving past that to create space for future growth. So it's not just about speculative speculative capacity. It's also about space for business that we've already got.
Well, that's a very neat link into a question here from a happy shareholder in Lancashire, who is very pleased to see that you are creating more jobs with warehouse and production facilities. But looking forward, presumably transport costs are an important factor for you to consider and for your clients. So when do you think you will need more regional storage and production facilities?
Our current warehouse model, the new one, let's say, has a capability of accommodating up to £200 million worth of sale. As and when we are at or about that level, yes, we will consider further warehousing space, but it is more likely to be farther south simply because of the potential nature of the customer base, and it's more southern centric. That's not that we don't like Lancashire. We love Lancashire. I was born in Lancaster, so I'm a true Lancastrian.
Thank you. Tesco and Booker, opportunity or threat? Booker's a very good client for you at the moment. Is there a chance that they could be told to diversify their suppliers more?
I think it's difficult to answer that question. The merger's got to be approved by Competition Commission. I have no doubt when we look at that there will be opportunities and there'll be threats, but we're clearly making sure that we continue to look after Booker because they're our single biggest customer, and by looking after Booker we believe that they will then sell our capability into Tesco and after a positive experience. But clearly we already do a small amount of business with Tesco as well.
Right, James, a question or congratulations from a listener on the fact that you have been able to buy lines of production second hand. Could you just give us a feel for how many of these lines are available for the future? And looking at Steve's medium-term target of £250 million of revenues, how many lines would you expect to be needed to supply that?
It was a speculative opportunity that arose to acquire the lines, the 2 lines second-hand, which are the 2 lines that Steve referred to earlier that have been installed into Leyland. Just to give you an idea of the economics, a typical line at the minute will cost you sort of around about 4 million. We spent 3 acquiring that line back in April 16, and we've spent about 2.5 million adding and enhancing that machine. So we spent 5.5 million in total on those 2 lines, so giving us a saving of about £2.5 million. We're always open to opportunities that arise. We've just announced that we are investing in a 3rd line for Leyland. There's an RNS that went out about a month ago. So it'll probably be a mixture of both of those different opportunities.
And the answer is 21.
21
lines.
There you go. Half of 42. That's always the answer, isn't it?
No, I think the question was how many lines would we need to get to 250 million. It's 21.
Right, and then perhaps just a last question from John. Obviously quite a lot in terms of your fortunes this year does seem to ride on price increases. Could you just look us in the eye and say you're hopeful, confident, optimistic or fearful?
Well, any one of the above. No, look, we have to, the industry has to, the whole manufacturing base in the UK has to find a way to recover the inflationary headwinds. We're not looking at 1 or 2%. We're looking at significantly more. We are in the process and will continue to chase inflation recovery because everybody needs it to be able to maintain margin.
Great. Well, we wish you the best of luck in that. Thank you very much for your transparent presentation. Thank you to our audience for staying up late and for your perceptive questions.
Cheers.
Thank you.